people from around the world tune in to our experts at the Wealth Press Roundtable.
Great. Thank you, everybody, for joining us for Wealth Press Roundtable live, as you can tell. I'm Laura Cadden with the Wealth Press editorial team, and manning the chat is our editorial director, Chris Warder. Want to say hi, Chris?
How you doing?
There he is. So he's also handling all of our technical aspects. And of course, today we have Garrett Baldwin. Yay. We have Don Yoakum. Yay. And we have our own Lance Ippolito. How you doing, buddy?
Very busy.
Busy's good. Busy is good. So we'll dive right in. So one thing we haven't really talked about on Roundtable is the politics, the political situation at the moment. So in DC, of course, Congress will be divided for at least 2 years. These kind of divisions are often good for stocks because there's less legislation getting pushed through and less political interference with the economy. Do you think that will be the case this time around? What do you reckon, Don? I'll start with you.
Well, I think they are going to have a hard time doing anything, but it's not like they can undo all the stuff that they've already done, right? So there's, what was it, 1.8 trillion? And anybody know exactly how much stimulus got through over the last 12 months? I mean, it's a big number. There's just that money coming on, and it's not like they can undo anything either. So, we're not going to see a fairy tale tied up Senate or Congress having any major effect on the markets, right? It's already been done. It's going that direction. So that's it.
You think we're set? How about you, Garrett? What do you reckon?
A couple of important points. First off, the Freedom Caucus is pushing we abolish the IRS. These are all political efforts. They say that they're going to do this when they're going to run. They're going to be able to do this. It doesn't help because they're not going to be able to mainstream and get something like this through a Fair Tax Act. But here's the important component of this. Jerome Powell yesterday explaining the importance of independence of the Federal Reserve. This is very critical. A lot of people think that there's a political agenda. We're far more independent than any other central bank around the globe. And why does that matter? Yesterday saying we are not going to be a climate change bank. That was important to hear. But here's the key thing. Congress might not be able to do anything, but the Federal Reserve is fighting inflation by itself. So Congress just passes $1.7 trillion omnibus. The big challenge for the Fed is to come out and not do a repeat of the 1970s, which in the 1970s, Artie Burns was fighting the Vietnam War spending, the Great Society spending, all of the COLA benefit increases that happened during the 70s, and the inflation caused by a lack of supply side issues. The United States Congress doesn't get supply side policy through, and they're likely not going to, on energy, on food, on water, on our rail system, on things going on with our airlines. These things are going to come back. They're going to come back maybe 12 to 18 months from now. Powell coming out and saying what we're going to be doing is not popular. You're going to hear the Freedom Caucus. You're going to hear the progressives on the left effectively saying 4 to 5 months from now, you need to start cutting rates. You need to start cutting rates. You need to start cutting rates. They're not going to do it. And this is really, really important moving forward. Now, the other thing about Congress that I'm very worried about is in August, we get to a debt ceiling vote, and they have not addressed this. They need to start this now, because if we have a repeat of 2011, the very idea, our Congress now, how much they've added in debt in 12 years, we are in a very precarious place right now because we did not have high interest rates in 2011. Now we're talking about high interest rate environment with 10, 15, 20 trillion more than we were back in 2011. If they don't get out in front of this, we are going to potentially have a debt ceiling crisis in August. And that is very, very problematic to the potential recovery on the backside in 2023 and early 2024.
That's heavy. What do you think, Lance? You got any thoughts on this?
I don't think they'll do anything. Nothing will get done. I will say what I don't get too much into the Fed or care. Someone mentioned in the chat, Powell is non-political. I will say, though, what is entertaining to me right now, and I can't get enough of it, is the George Santos situation. I know it doesn't really have anything to do with the stock market, but I am just so like every time I see his name or like his a pop up, you know what I mean, when you go on websites and stuff, and there's a new scandal about him taking money, faking his resume and stuff. I don't know why. I can't get enough of it. It's like I'll sit at night and I'll start drinking wine and go down the rabbit hole, and then I'm like, man, if this guy, you know, can get into politics, I mean, how do you have any hope of any of these people doing anything? So, does it really affect my book and my investments? Not really, but my goodness, oof, how corrupt.
Yeah, he's a sketch dude, no doubt. Well, let's move on to 2023 and about how options trading and stock investing is going to be different in 2023. Garrett, you and I spoke the other day when we were at dinner. You mentioned that you thought the old rules of selecting stocks doesn't apply in this new environment. I thought that was a really interesting statement. I'm going to ask you about that in a second. And Lance, you talked to me about expecting a reversal in the performance of stocks that were hit hard last year. Perhaps you're thinking about, well, I won't say what you're thinking about. So I'll start with you, Garrett. What do you reckon about what kind of changes and how you have to look at your investments going forward?
Well, I think that, what happened in 2022, I think we're going to see a little bit of a repeat of that. There's going to be volatility. There will be some choppiness. And again, the focus is going to be on the Federal Reserve and its balance sheet. They're going to reduce their balance sheet by by $1 trillion, peak to trough from their tightening. And there's a direct causal relationship between the S&P 500 and the Fed balance sheet. I think one of the things that a lot of people are trying to do is kind of pick the bottom. And I think that that's a little problematic, because why spend the next 6 months trying to guess and pick that bottom when you can really just kind of focus more on going out toward the long term? And the way that I see it, I think that there will be a second inflationary wave at some point. So my focus is really built around the stuff that matters: the food, the energy, the inflationary trade for, what could potentially be that lost decade. I said this 12 months ago. BlackRock, Fidelity, a couple other firms, Bloomberg mentioned this yesterday. Focus on the stuff that matters. Focus on, where there's value. There's plenty of value in the energy side. There's plenty of value if that is what you are doing, if you want to sit this out and avoid all this choppiness. But if you are a day trader, I think you're looking at reversion patterns. I think you're seeing things moving into the third standard deviation, and that creates a buy the dip opportunity. This is a totally different market than where we were in 2008, 2009, coming out of that crisis. Far more algorithmic, certainly not as reliant on fundamentals as we were at the time. It's going to create a lot of challenges for people. And the thing that I'm worried about is that because we're going to be in this period that's going to be really a trader's market, I'm sure Lance is really excited about it, as he should be. But, this is a wealth machine, the markets, and you have to be focused on the longer term. I don't want people to, be stuck in this kind of spasmic market that has been 2022 and will probably continue for a couple of months, and throw in the towel and say, this just isn't worth it anymore. I've seen that happen. That happened to people in 2008, 2009, and then they missed the 10-year bull market.
Right. Very true. What do you think, Don? Do you think we have a new environment? Kind of what's changed?
No, I think we're continuing on the same environment, right? When I think about what a 10-year bull market might look like, I'm trying to think what's the catalyst, right? So that 10-year plus bull market was a result of taking, Fed funds was 5.5% in 2007. All right before they started to cut, and took it down to zero. That was a massive tailwind and driver of PE expansions. You also had real interest rates coming down from probably 3, 4, 5%, maybe 7%. So real interest rates are, can be a signal of real growth in the economy until the Fed starts moving them the other way artificially, right? Which is what they're doing now. So real rates have come down. You don't have that real expectation of real growth. So you don't have PE expansion. You don't have real rates because we're at a headwind, right? That's a headwind now. The earnings cycle has, to me, very clearly peaked, right? So we've got a lot of flushing out to do, and the markets aren't in the same position as they were in 2008, 2009, and you don't have a Fed with the appetite, and a Fed is going to be much more aggressive over the near term than the markets are pricing in, right? The markets are expecting. There's not only are they fighting against stimulus, right? Now they're fighting against the reopening of China, they want to fight. They want to win this. Central banks are fighting for their survival against each other. They all work themselves up against a cliff, and now they're starting to push each other off the cliff instead of holding hands, right? So, the Fed really wants to win this battle versus the ECB, the Bank of Japan, the Bank of England. And so, that there's just too many other, not only just fundamentals that we had going into 2022, going into last year that, were happening anyway. And now we're fighting the Fed. So, this, I don't see this long-term thing. So, over the near term, I think, you might be able to pick your spots and trade your way on the long side here and there, right? But I think the general, we've still got a lot of flushing out to do. Probably a couple, 1,000 points, 1,200 points on the S&P. It's just it just takes some time for that to work out. But right now there's, we're kind of in this middle area, but that's the tough thing that I see to navigate. And then, who knows when the volatility actually kicks in, that just makes it all either really great or really tough.
As always.
How you pick your spots. Yeah.
So Lance, you have more of a contrarian perspective, don't you? Want to talk to us about that?
Yeah, I mean, this year, and I don't know if anyone watched my Outlook video of 2023, it's been exactly what I thought, and it's just been some of the best trading ever. I mean, we're 11 days in or so? Yeah. I mean, Friday, to give you an example, we saw massive buying in semis, Marvel, Intel, Qualcomm. Monday morning, wake up, Wells Fargo upgrades the chips, AMD, Marvel, Qualcomm, names like that. Those stocks were up 3-4%. The call options were up 50, 60, triple digits. I mean, I was in the trade for a day, right? So Friday out on Monday. That's what the market's giving you. So like everything, all these people that were buying and holding, that's over. Everyone who was buying healthcare and energy stocks last year, those names are getting crushed. What names are moving higher? Your Amazons, your PayPals, your Square, your Teslas recently. Nice squeeze there recently. The names that nobody loved are seeing just massive moves. And when you're trading the short-term options like I am, like Amazon's up 4% today. I mean, even your travel stocks, your Deltas, your UAL, your Lyft, your Ubers. I mean, I'll put on positions. Like I bought Lyft calls the other day. In less than a couple hours, they were up 40%. I mean, that's the kind of action you're seeing. So if you're a short-term trader, like I am in the short-term options, I mean, it's a party. Like I can't send out trades fast enough and to people because stocks are moving that quick. So it's so much fun, but you have to use obviously proper risk management, but it's like waking up, the market's open and it's, and then an hour into the day, it's done. I mean, it's that much fun out there. So, if you're not trading short-term options, I trade institutional order flow in the options market. I mean, it's a party. Like every day this year is just about been a party. And, I hope it continues out there. I have a very short-term outlook. But what I'm seeing here, especially in some of the large cap tech names starting to bottom, I mean, I'm loving it. So.
Well, let's move on to December CPI is coming out tomorrow. Any thoughts on what we're going to see, Don? You want to start us off?
So
no pressure.
I every time I get questions like that, I think of all the hundreds of millions of dollars allocated to paying people to guess what that number is. And they all guess the goddamn same thing. They all get the same level, and none of them get it right. It's less about the actual number and more about how the Fed statements, reacts to it or whatever, follow-on statements, that sort of thing that we have. I think it will surprise to the high side. I think the wage pressure, we've moved one factor through the price pipeline, I guess you could say, and that was oil prices and a lot of supply chain snarls, right? But a lot of manufacturers weren't able to move their prices. There was a little too much price stickiness, right? So that's getting adjusted to, right? So you had the big change, and now there's not a change in oil prices, right? But now you're getting a big change on people that on goods, more services related, maybe more sticky price points. And also, of course, wages, right? That's something that everybody's fear about. They dread it from the 70s, but it's a real issue. And there's this baked in demographics of retiring baby boomers, which, and I frankly forgot to even really think about it for a long time. And that is that, you've got this, the working age population, the workforce has been shrinking significantly, right? Now you thought, stimulus and welfare and stuff like that. No, it's just baby boomers. They're retiring. They are no longer in the workforce. I think it's something like 10,000 a day, right? I mean, that is, and we're almost right back to how the working age population as predicted by the demographic boom of baby boomer retires, right? So that's a massive constraint on markets, on wages, on labor. And that's going to be a real issue. I think the Fed knows all this. The market might rally on a softer number. But I mean, that they have projected rates, the markets is projecting a peak, I think, in March or April, right? And then actual start cutting rates. That's a fantasy land, right? That is not going to happen. And so, there might be a short knee-term reaction, but I don't think there's another, like if we're talking an S&P 500 points, I don't think there's another 200 or 300 upside points on the S&P 500. Just not, that doesn't matter what the number comes in, it doesn't have it. You might get 100, 150 points, that'll hurt if you're short, and all that, but you're not going to get another 300 points on the S&P 500, no matter what. Recession is cooking and is settling into people's mindsets, and inflation is way more stubborn than they think. So, I think for the number tomorrow, let's say, well, what's the expectation? Whatever expectations are, add another 10.1 percentage point. I think it'll come out a little higher, but the real, if it does rally a lot, you can expect Powell to come out and say, hang on a second. You get over yourself.
Do you agree, Garrett?
Well, first, I don't care, right, about the number itself, because one, the only thing I care about is momentum. Momentum went positive on Friday. So every crappy short squeeze stock in the world is moving higher. Amazon's moving higher. Capital flowed in on Friday. But I agree with Don. Look, the key thing here is the Fed's not raising, the Fed's not cutting rates this year. They're not doing it, but it doesn't take much for a Goldman Sachs, for a BlackRock, for any narrative to shift this quickly. We have gone from all hell breaking loose in December to now there's not going to be a recession, and now the Fed's going to pivot. And this is just the way that this market is working. It is an echo chamber. So where does the market go if the CPI number comes in lower than expectations? I'm right there with Don. It pushes the 200-day moving average for the SPY, which is 1.3% away, and that's it, because the trend is lower highs, lower lows. It's the bear market type of rallies. We had that rally come out of low volume out of June, took us up to the April 15th, right to the 200-day. We broke down. Same thing happened in November. Same thing happened in April. That trend is likely to continue. And I have a year-end target down at 32.50. Like, I think earnings compression is going to continue. So this short-term number, I think you have to look through it. You have to discover, why is the CPI number lower? Well, energy prices were lower. But why were energy prices lower? You have to ask that question. It had nothing to do with demand. It really had to do with the fact that the commodity trading advisors were completely gone. So all the speculation in that market disappeared. It was the lowest amount of exposure for CTAs in 10 years. And remember, there are people who need oil, and then there are people who speculate it. There's about 6 to 7 contracts for every barrel of oil, and nobody was trading the contracts last month. So that's really important to consider. I think what matters is what happens next month, because where are we going to be sitting in January? How is inflation going to be impacted by China's reopening? We are at a very weak economy. Aggregate demand has been beaten down, and now the question is how much is this consumer going to be able to take? Don talked about real interest rates a little while ago. This is really important. If CPI is 6.5% tomorrow and the interest rate in the US economy is 4.5, let's just throw that number out there. That means real interest rates are -2, and -2 spurs economic spending. In Europe, when they were driving interest rates lower, they were trying to spur demand. Well, it works the other way as well when inflation is higher than the real rates. So consumers are still spending, they're still tapping into their credit, and eventually when that real rate does go positive, I think that's when the brakes completely halt, because now consumers, the economic perception is I don't need to spend because my dollar is going to be worth less in the future, and that is going to be very, very difficult for the consumer economy on the second side of this second and third quarter of this year.
That's an interesting point. When I'm thinking real rates, usually folks like 5-10 year and how that prices assets and stuff like that. But no, you're right. The Fed is way behind the ball still. If you compare the Fed funds rate, if you think of real rate terms in terms of Fed funds rate versus current inflation level, right? They are as far behind the ball as they were in the early 70s. They haven't even started to cut. I mean, they haven't even really started to hike yet in those terms. I mean, yes, that does have a lot of impact on the consumer, because they can borrow cheap, and you've seen that savings rates have plummeted, consumer credit has soared, and once they get a hard wake-up call on what those on their credit card statements or whatever it is that triggers that pullback. That could be a very, because that's really the thing, right? People are still out there, they're kind of spending. You've got earnings are soft, and companies are starting to lay off in anticipation, but you're still seeing what looks like people that ain't that worried. So that's the tough part about where we've been, and whether are we in a recession or are we not. And I think that's a great point.
So Lance, as a trader, do you have a plan to play the reaction either way?
I mean, I just trade a lot. So, I mean,
just react.
Wherever there's big calls or puts.
In fact, he's probably trading right now. He usually is during the show.
I'll be honest. Everyone was talking. I just put out a new trade alert. So check your email, text, and Telegram. Buying some lift calls. Obviously a high PE piece of junk stock. But and I'm buying the January calls that expire next week. I bought the lift 14 calls for next week. So that's how much I'm trading there. So I don't know what the proper response is, but
it's all good.
You sign up for my premium stuff, you'll get a trade alert here. I just sent it out.
So, a final question for today. Some experts are pointing out the market is not oversold or overbought at the moment, and suggest perhaps covered calls or credit spreads after a bear market rally is the way to go. Do you think a sell the rally strategy to be the right call right now, or are they missing the boat? What do you think, Garrett? We know what Lance thinks.
Yeah, I don't
but we'll get to Lance.
Look, again,
that's too complicated.
Yeah, I mean, the way that I focus is built, I'm looking at the RSI, the MACD, the MFI, the ATR, and the ADX of the SPY. And that's typically what I trade. I'm waiting for all 4 of them to turn positive. Typically they do so in, effectively the same day. I make my money in those 2 to 3 days. So I'm going to be done today. I'm going to be shutting a lot of stuff down because I don't know what the uncertainty of the CPI number looks like. But with that in mind, I think there's a lot of opportunity. If the CPI number comes soft and we keep pushing higher, I would be selling put spreads to the downside on stuff that I want to own and just look short-term duration. I'm looking for companies with an implied volatility rank, probably over 30 to 50. And then I'm specifically looking very far out of the money where the probability of profit on the trade is about 80% to try to make about a 20% return within a 30 to 45 day period. I think that we're going to probably trade sideways into February, and then we're going to start to get a little bit more dose of reality on the consumer spending side. This is going to be an interesting next 2 to 3 weeks.
All right, Don, how about you?
On the sell the rallies, yeah, I think so. When they look, if you got an individual name that looks really overextended, or depending on how you look at it, I focus mostly on directional stuff. We are what it looks like in the churn. How CPI kicks us out of it. We'll see. But I just kind of right now I'm just really focusing on being in the market a little bit, at the margin, trying to play the short side. If I see a compelling long, I'll do it, but I just don't see it. So mostly I do directional trades anyway, until you get some massive spike in vol, right? That's when I think, selling vol and pulling it in is great. But right now it's right. Playing calls and puts and looking for those big directional moves, that's the way to go, because they are going to start, and so it costs you a little bit in the short term, but then the upside is pretty significant when it's get there, and I think we'll get there within the next 2 months for sure.
Good to hear. So Lance is correcting his alert that he just sent out. Thank you, Ron. This is what happens when you're distracted.
Yeah, this is multitasking 101. I mean, I will say this. I like Garrett selling bull put credit spreads. I've been doing that recently. I've been selling a bull put credit spread on the weeklies to finance long calls on, some, like we did Shopify last week, Tesla today. So basically selling premium on high vol names out there, which has been good, because then you don't have to pay an arm and a leg for the calls. But I have been putting some, it's a weird situation, right? I think stocks have bottomed. So obviously my long-term accounts, I've been putting money in, peppering in like maybe once or twice a month. Like I've been buying some Tesla, some Netflix, some PayPal, some Net. I bought Robinhood and structure notes, by the way. So I get a high limited risk capped reward. But also too, you got to figure you're getting, one of my guys called me from a firm, and he was like, hey, our money market account, I think it's the JP Morgan liquid something, it pays about 4% right now. So that's another pickle where you're like, hey, I could get 4% in a money market account liquid. Do I really want to risk trying to make X amount in stocks, especially when you see, stocks having big red days. So that is, a something that, people with a lot of money are probably in that same situation, thinking, can I get let's say basically guaranteed 4%? Obviously that can change. Or do I want to try to bottom fish stocks, which can be risky? That's one thing that, obviously with the rise of rates, that, people are in that scenario. And I think if the market can actually start going up in this environment, I think that's, very strong and very telling. That's to be seen. But so far this year, especially after a weak start of the year with Europe and, China and other markets being strong in the Hang Seng, markets look to be, I don't want to jinx it, but they look to be, decently stable. You can even say bullish right in the short term right now.
So what strategies do you prefer at this time?
Well, if I can grab the screen and have the good old slide deck going. Now I'm not going to
Go
pitch
for
anything,
it.
everyone, so don't leave. Basically, what I have been doing, and last week was a big week, and I sold too early. If anyone's still holding Marvel or Intel calls, we've been trading on Fridays and then closing out after the weekend. And most people obviously never consider that, but for us, it's been some of the best results. Obviously this year and last year. Rivian, would I ever put $1 long term in Rivian? Heck no. I think the trucks are $130,000 for a truck. You're crazy. But we did 68% over Memorial Day weekend. Apple, another long weekend, was 60.5%. The Dickens has it, wiretaps. Labor Day, we had Peabody, BTU, 69%. Las Vegas Sands over New Year's Eve, which if I held another day, the stock was up, what was it, 6% the following day? Those calls went up like 3x in value. So it's been a very solid strategy. I like it. It's my favorite. I put the trades on with you guys as well. And the markets are closed Monday for MLK Day. And that's another opportunity for us because on MLK weekend in 2022, we had some wins in Las Vegas Sands again, PayPal, Corsair Gaming, some nice gains. I feel like Las Vegas Sands, obviously the casino stocks, you have the Macau numbers coming out from Macau. You can think in your head if casino stocks are a little corrupt. Obviously, it's the casino mixed with China. It's a whole nother story. But every holiday last year, was pretty hot. We had about 75% accuracy. Obviously not every trade will be a winner. There will be losers, but the long weekends have been very good to us. So we're going to look for the next opportunity. So that starts this Friday. And we have a 3-day long weekend. And we found some names like this was December, Peloton, Juniper, CrowdStrike, CSX, Microsoft the following weekend. CarMax, obviously those puts paid off well. We do outright calls. And then if we think the stock's going to go down, like CarMax, we do puts. And then we did some names, again, Las Vegas Sands and Baker Hughes. And then we did a pretty big win in Marvel, the semiconductor this weekend. Intel moved up a lot too. I just sold it too early. So our trades go out Friday, 3 p.m. The long weekends have been very beneficial for us. And we want to see what magic happens. Buckle up, because today at 1 p.m., it's the most important time of the year because I'm going to show you how to take advantage of the long weekend, which we have again this weekend. Right there. They even wrote it on the slide deck, and how you can take advantage of this long weekend too. So in 2022, I think we all know it's been choppy. It was, very bearish, the markets. It really saved us. And a lot of people have emailed me and messaged me that that the wiretap program saved their 2022. So we already kicked off 2023 with a bang, and we started doing this in September of 2021. And, we get audited. We have all these math nerds doing it. And these are the numbers they gave me. So pretty incredible.
German math nerds.
Yes. So if you have a small account too, you can do this. I was trading this with a $7,000 account just recently. So, small accounts is very friendly. We do 3 trades every Friday at 3 p.m. There should be a link, Hartley. Let me see. Click the link in the chat to join the room. There's the link in the chat. Why, thank you. So we're going to be going live at 1 p.m. How you can trade the wiretaps, take advantage of the long weekend. Might even do some WWE calls this weekend, World Wrestling Entertainment. And I'll explain that if you attend the webinar. And we'll do the top 3 trade setups this Friday. Click the Telegram, the text message, the link in the chat to sign up. I'm not sure if it will be recorded, so make sure you are there. But it has been really good. It's, I'm very transparent with my stuff. And if you guys and girls want to attend, feel free to join. I keep my trade tracker, very proud of it. It was very good. And yeah, it's been a great program. We buy outright calls if we think the stock's going to go up, and then puts if we think the stock's going to go down. So very simple to do. No spreads, no craziness. Very easy trades out there. How do we get those trades? If you go to the webinar, you will have the option to get them. They're every Friday at 3 p.m.
Awesome. So that's today at 1 o'clock. Please
Yes,
join
today.
Lance. Thank you, Garrett. Thank you, Don, for joining us again today. Little teaser, starting at the end of January and in February, you're going to be seeing a lot more of Don. Oop.
Ooh, a
Coming
teaser.
soon.
I like the
Mhm.
teasers. Come on,
Mhm.
you got to spoil the beans. You can't. You
Yeah,
can't give
I'll
a tease.
spill it later. It'll be coming. Just keep it in mind. But thank you
Well,
guys
I'll
very
tease
much.
the people. If you join the webinar at 1 p.m., I will. I'll give you my number 1, number 2, number 3 option pick for the month, and then Friday I'll give you 3 new trade alerts. But
Ooh.
there's just so much stuff happening that I can't. I physically can't type everything, so I've been trying to do more videos, and obviously the webinars are great as well.
If you guys aren't familiar with his wiretaps alert, by the way, it's one of his by far most popular services. Like everybody loves this service. So you definitely want to join him at 1 o'clock. Check it out. So thank you all. Have a great day. We'll see you next Wednesday at
all.
11
Thanks.
a.m. All right. Next Wednesday, it's going to be Celeste and Jack Carter joining us. And I think Roger Scott as well. So thanks, everybody.
Thank you.
Peace out.
All right, folks, I'm going to leave the room open here for just a second longer, and I'm going to drop that link one more time just in case. Lance's webinar today starts at 1 p.m. So be sure to save that link, or check Telegram, check your inbox, check text messages. We'll be sending it everywhere. All right, so we'll leave that open here for a little bit, and we'll see you next week. Thanks. Don't forget to like and subscribe if you're watching on YouTube.